Hi, and welcome back to the next part of this small lesson on comparing business structures. And as we were discussing about, comparison between public and private companies in terms of the legal structures, in terms of the benefits, in terms of the requirements. Now we're just taking a very simple example on how a private company, eventually becomes a public company through the IP route or the initial public offering, right? So if you see out here, this is a very common case. Probably you've heard about it, at least if you are an Indian. So Zomato was basically a company which was engaged in food delivery business, and it was started in, if you look at the initial phases, it was started in 2010, right? And this is how a company, if you're structured in a corporation structure, you obviously try to look for investors who can put in your money, right? So put in money so that you can actually grow and try to save you from a lot of profit issues. So out here, you can see this is called a seed round, which is basically an angel investor or venture capital, whatever you want to call it, basis the amount of funding that you're getting, right? So at that stage, the company was valued about 14.2 crores, right? And if you can see out here, 3 years then, in November 2013, you call it the Series D funding, in which the company valuation moved into almost 1,000 crores. Now, what happens is now in the CFA curriculum, this has been spoken a little more. I felt a little more academic, way, but I felt that it's more easier to understand this if you look at the practical angle of this, right? Now, you can see that how does a company's valuation, of course, trying to always appreciate the fact that the business has done its job in terms of creating value for the customer, but every investor which comes in every round as a private investor gets a share. So if there was just, let's say, two members out here, now considering that the third investors come, the stake of these two people is obviously going to get diluted, right? That because you are now going to share the same pie, if there is the same pie between three people, that means every new investor which comes leads to dilution of ownership. But dilution of ownership is fine as long as the pie is growing. And out here, it makes total sense because the first investor who came at 14.2 crores valuation versus now at a valuation of about 999, which is almost 1,000 crores, because the CQ investments in Zomato had happened in the valuation of 999 crores. So for the first investor, that's okay because as long as you're diluting and the valuation is going up, who cares, right? It doesn't mean that always that the first investor has actually exited in Series D. Not really necessary. He might still be there. Okay. Now you can see out here. This is where the company has become a unicorn. When we say unicorn, the company has almost reached a valuation of 1 billion, which is apparent out here because 6,000, around 7,000 crores is what is equivalent to $1 billion. So you can see here the valuation in Series G, is about 6,351. So there might be one more investor which has come. So as you can see, as at every stage, an extra investor is coming. In terms of private equity, the valuation is obviously going because it's in the interest of the previous investor. Out here, if you see the Sequa, who invested in Zomato in 2007, obviously he's interested in making the valuation higher. Why else would he be there, in the investment itself, right? Because he wants to make money. Now, after that, if you see out here, as we move into Series H in, after 3 years, after 2015, the valuation is about 6620, right? Now that's where Ant Financial invests in Zomato, right? Then we move in to final Series J. This is pre-IPO. Okay. Now you have to understand again, why would a company get into further valuations before an IPO? And I've actually covered this in a very separate analysis of Zomato's IPO. You can check it out on YouTube as well in the Mentor Me YouTube channel, when I have discussed on whether it had anything to do with funding or it had everything to do with the IPO, right? So just pre-IPO, the company also raises another series of funding called as the Series J funding, in which the valuation went about almost 3 or 4 times, right? So the whole idea of getting this funding was so that to the public, the valuation could appear to be at least greater than 224849. Right? And finally, in the current shareholding pattern, when the actual IPO happened, the valuation went up to 38,690. Right? So that's how the various, that's how the inside story of any funding is actually there. No company, I mean, why would you go public unless and until you have something? There's nothing wrong in this, obviously, because the company and the shareholders who have taken risk in the difficult stages are to be compensated when the company goes public and is held by a lot of people, right? Because it's very difficult, and it's obviously a lot more riskier to invest in companies which are at initial stages. So of course, if you say that this is unfair, probably it's unfair to you to say that it's unfair, because finally the higher risk has been taken by the private equity investors as well, right? But obviously that doesn't mean that all the valuation is right. I would not have agreed with the valuation which was given, and it's pretty apparent in terms of the stock performance today. All right. Now, if you see the shareholding, now it's no more just private shareholding which is happening out here, right? So you've got others in 37.9%. Info Edge, which is actually the company which represents Naukri.com, which is basically a job search engine, has about 18.7%, which has always been an investor in in the Zomato business. Right? Then you've got individual people. Then you've got some mutual funds, I believe, is the investor out here, and then you've got other investment vehicles which have invested in Zomato. So that's how the shareholding changes across periods of various funding, right? So let's move further in understanding the actual breakup. So this is the actual breakup. If you want to actually refer this is available, right? And now this shareholding is actually shown as a part of the disclosures for every company in their annual reports, in their website, everywhere, right? And also the pattern of how this shareholding changes across time. Now let's try to understanding financing in terms of stages of firm. Now we can see in Zomato initially why does a company seek funds, right? Because the question is that in the initial stages of firm, and specifically when you're talking about disruptive technologies, okay, I'm going a little off topic in discussing this, but it's probably necessary for you to understand rather than just trying to understand this as per chart, because the chart will just talk about in terms of the outcomes, but why this happens is what you need to understand. Specifically when you're talking about disruptive technologies, right? Let's say we are talking about Meta today, right? So if I say that Meta is a disruptive technology of the future, but there are no customers today. So if I say in 2022, the customer base, okay, or the customer in terms of revenue probably is less, right? But let's say I say that this can become a revenue generating model in 2032, in which the revenue can go pretty big, right? The only way by which you can actually do this if you have sufficient funding in terms of taking the operating costs, because business works on a simple structure of revenue minus expenses, right? And in order to build something which probably will become operational or in terms of profitable after 10 years, means that you have to bear in the expenses until then, and you need to survive, right? And that's what is mentioned out here as the valley of death, because in the initial stages, when you don't have much revenue and you have mounting costs, and you can't even slow down your development in case of disruptive technology, because if you slow it down, probably a competitor will steal your idea and probably will get ahead of the game, right? And hence, the requirement of funding is necessary. It's not just a very fancy term. A lot of people will say that it's funding business, but it also depends upon the kind of business that you're starting. For example, if you're starting a restaurant, right? If you're starting a restaurant, it's not really necessary for you to have funding, right? Because it's not really a disruptive technology, and you will have revenue and you will have expenses, right? And there is a good chance that if your product is good, if your restaurant is good, then there's no requirement for you to cover these expenses, unless of course you are doing expenses which is beyond the business requirement. In that case, your business will anyway close, right? So it is the requirement of the entrepreneur who requires that funding just to survive, right? Now, as you can see out here, as we cross the main stage where the company has somehow got into the break-even stages or is generating some revenue, then you get into the early stage funding in which you have VCs. You might also get acquired by larger companies, right? It's not always necessary that you have to get funded in the same way how Zomato has get funded, right? Now, Zomato has got funded because it intended and it always had Info Edge as the investor, which, I mean, it's a huge investor, right? Info Edge already runs Naukri. So for them, running operating costs or synergies was very easy, right? But it's not necessary for all the firms to stay that way. It can also happen that a larger company in the same space might come and acquire you and you might be okay with it, right? And it's not always necessary that you will give up all the stake. It can also happen that you might just give up a part of the stake and you still operate the business, right? So anyways, I mean, initial stages, you are getting funded, and out here you can see this is the break-even point. And once you're beyond break-even point, it even generates more interest to the investors because now the likelihood of a loss is lesser, right? So as you can see out here in Zomato funding as well, as the company has started growing in terms of revenue and valuation, more and more investors have got interested. It's a very separate story in case of Zomato being actually profitable, because even during the IPO, Zomato was not profitable, and still it is not. But in generic sense, if the company is even profitable, then even great, because more investors would be ready to take on the risk, because the likelihood of loss is pretty less, right? And then you get into the third and the fourth phase of the business. It's pretty near in terms of getting into a secondary offering in terms of an IPO, and it's also called as the mezzanine financing, right? So, and you can see out here in Zomato case, these fundings would be categorized as the later stage funding, right? And then you get into secondary offering, or you can get acquired by some bigger public company as well, and that can also happen. So it all depends upon the dynamics of the business. It's just not always true that it has to follow the same pattern that has been mentioned, right? Now let's try to look at the financial claims of various people as a part of a business, right? Now, when we are saying financial claims, all we mean to say is that when we operate a business, right? Let's say we are operating a restaurant, right? And we've got our owners on one hand, which includes you who's operating the business, right? And you've got your suppliers of raw materials or whatever, things you require to cook food. And also you have, let's say you've taken up a debt in place for the place that you've actually bought. And so you've got debt as well. And the question is, although this is discussed as a part of many curriculums, that the various rights of claim in terms of the ownership. However, it doesn't. The first and foremost question is, you cannot have a claim against yourself. That means, how can an owner claim himself against the restaurant? Because there's no such legal course, because you're the owner. So if in case there's a loss, you will be compensated obviously for the loss, because it's your business, right? I'm really surprised that this actually even turns up in a lot of books in academics, that why would you even discuss this? Because let's just try to understand that you are the owner of the business. How can you have a claim against yourself, right? That means you're taking up the entire risk of owning that company. But suppliers do have, because they're not the owners of the company, and even the debt financing people, suppliers of debt, are also have a claim against you legally, because they are not a part of the business. It was a contract. Right? Out here, it's a contract. And they supply you something and then you get it back. So if in case you're violating that contractual terms, you get sued. You have to make good on what loss you have made to them. Right? And in the same in case of debt as well. But in case of ownership, right, when you buy a share, you're really not getting into a structure of give and take. You're becoming an owner of your own property, right? Your contractual terms ends when you buy it from another person. So if A buys from B, this is the contractual terms. But once you become the owner, you have no rights against the company apart from the ownership of the company. That means it's similar to saying that if you bought a property, the property is there with you, everything is fine, the contract is over in terms of buying and selling. But now, how could you claim against your own property? Right? There's no such recourse. But what is more important is to understand the risk profiles. Okay, and this is very interesting. Right now, if you look at the risk and return profile of a bondholder, then you are talking in terms of, let's say we are saying that this is the 0th point, right? We are saying this is the value of issued debts. Okay, so this is debt investments, gain and loss versus the value of the firm, right? So if I say that this is the value of debt, okay, so this out here is, let's say 50, okay, and the entire value of firm is debt plus equity, and let's say that is 200. Okay, now if let's say with time the value of firm is increasing, right? So now what does happen with, let's say, a bondholder? Now with the bondholder, there is a limited upside, because this is nothing but interest that the company will pay you of all the gain and loss that the company is going to make, right? So that means if we have made at this point this much gain, you're not going to get this extra benefit as a bondholder, but you're going to get a claim legally. You have to make good of this in terms of interest, right? And there is obviously a limited downside, because you don't participate. If you're not participating in the upside, neither are you participating in the loss. That means loss or gain is immaterial for a bondholder, because he has to be made whole on the interest plus the debt repayment which happens. Whereas in terms of an equity shareholder, the loss and equity investment, if you're talking about gain and loss in terms of revenue or profit, there is unlimited loss and unlimited upside, right? So it's similar to say that if the company makes 100, it's as good as making minus 100. Both are same to you. That means you are taking it both the upside and the downside. Obviously, in one way we are saying also that the company's shares cannot go beyond zero, right? It cannot be less than zero, but definitely a lot of companies can be zero, right? So every time you are taking in a share of company, you are taking the risk of the entire company might just get terminated or may go out of business, and that's the risk in terms of the loss of equity investment, right? So let's move further in terms of the issuer perspective when you are raising debt and equity. Okay, now when you're raising equity, in any case, okay, the capital cost is higher. The reason is because you're diluting your own stake, right? And you are giving up your opportunity. No owner wants to give ownership to anybody else, because the opportunity cost is higher, because he is now going to participate as the owner of the company, and hence, although it might sound very fascinating to raise funds in terms of equity, but always that's a very expensive capital source. Whereas in case of debt is lower, precisely for the same reason, because you are only sharing this part in case of debt, right? But in case of an equity, you are sharing quite a lot, and there's no limit to this, right? But the benefit is the risk. In terms of the business not working out, if you see out here, right, it's not limited to how much he has been. There's no obligation that there can be any suit against the investor when the business is not doing well. But in case of debt, even if your business is stopped, you still have to pay the debt. Right? That means you have to still clear your dues. The returns in terms of equity is nothing but, if let's say we shut down the business, then all we can do is take the net assets, right, and give it to our investors after we've paid everyone. But in case of debt, we have to just make whole of the entire debt repayment. So that's a very simple reading in terms of the new lesson which has been introduced in terms of corporate structure. I think most of it, apart from a few of them, in terms of the start of the content which we spoke about, in terms of private, public, general partnership, limited partnership, proprietor, is something which is probably new. But any of the other content which we've discussed would anyways be covered in various other topics in the entire curriculum. So even if you do not understand the risk and return aspect of it right now, it would get covered in equity. So you don't really have to worry much out here. Just get a hang of how businesses are structured, how they go public, how they get private, from understanding various other content. I think that is to suffice the actual objective of this new reading, right? So I'll come up with a new lesson in the next lecture. Bye bye.